Hey, good morning, everyone. So today I would like to share to you a little bit secret about the hidden cost. Hidden cost here is the one type of the cost that I often say that is the market noise. And by understanding the market noise, you will have better position sizing understanding. So most traders, they obsess about the spread and the commissions. But the bigger cost is the volatility. They have to survive before like any trading or any kind of strategy that they want to apply. So the thing is, most traders they kind of scalping. When they scalp, they will more look at the the spread and the commissions. But to me, my philosophy that we should not trade the noise. When we trade the noise, maybe the outcome is like, yeah, if you're good, you can get like a positive profit. And but in terms of the risk reward ratio, the amount of risk that you have to pay to get that return, it's it may be it's not worth. And now empirically, we don't find any evidence of the one that can scalp can really outperform in the long run. So let's get back to our topic now here. So what is the hidden cost I want to share to you? The visible cost, what you see is the commission, the spread, the financing. As I told you, this is very easy to measure. But compared to the hidden cost that I want to emphasize is the market noise. Those visible costs are much smaller. So the invisible costs, they are the market noise. Okay, so you understand it in a way that in a time frame you enter an entry, and the market will volatile and oscillating around the entry point. So basically, it's a volatility, it's a noise, and we cannot say anything about the noise, because it is noise, so we cannot predict any moves within that range. So let's say in the M1 chart for gold price, normally we can estimate the such market noise as about 3 to 5 times ATR, so which is equivalent to 4 to $7.5 when we use a lot size of 0.01. So basically that if I enter the trade, I will talk to myself that I will have to accept the risk of losing 4.5 to $7.5 because of the market noise. So by understanding that, I will understand another thing is, if my trade has some profit, I will try to gain relatively to such accepted loss of $4 to $7, which is the take profit I often said is about $7 or $10. So that's worth about 1 to 1 or 1.5 to 1 risk reward ratio. So it's good in the long run, because if I scalp with a low risk reward ratio, it as I said, that it's not worth standing like sitting in front of the screen and trying to scalping every day, every session is very worthless. Well, so the same thing in the M5 chart. We also have similar calculation for the invisible costs. So if you look at the M5 chart, by the calculate 3 to 5 times of ATR, so normal invisible cost is about $12 to $20 for 0.01 lot size. So that's a part of the game. So depending on what time frame you choose, you will pick yourself the cost that you have to accept as market noise. So my idea is that I want you to understand the invisible costs, and then my next recommendation is that you should not put the wrong stop loss level. You'd better not placing the stop loss inside the noise, because it will change your calculation in terms of the strategy and the risk that you write in the paper. Even though that you maybe, let's say in the M5 chart, you just want to accept the stop loss like about $3, but the market noise is $7, or even $12 or $20. So you put the stop loss as $7. It doesn't make sense. So one day you have, maybe it is a good day, you can survive the stop loss and you have the profit trade. But in the long run, if you take the statistics, you will get more frequent stop out trades. So you should measure the noise by looking at the ATR or the Bollinger Bandwidth, or any measure that you want to understand the price volatility. So whatever you take, you should understand that it's a costs. And then you size the trade in terms of understanding the invisible cost, and you will place the stop distance outside the normal volatility range. And then you go back to your account risk. You understand that you want to like risk 1% of your account or 2% of your account. So based on the stop distance, you will know that this trade, how much size you will want to put on. So let the market decide the stop. So when you place the stop loss beyond the volatility range, so it's no longer you playing with the noise, and you will face the true, you will have the chance to implement the true prediction of the market price. Survival. Because if you tighten the stops and you increase the size at the same time, you can be directionally right and still lose money repeatedly. And this is again why when you get the stop loss so frequently, your short-term trading is very deceptively hard. So the shorter the time frame, the larger the influence by the randomness that you will get, and you will have less reward room because you just simply stop out by the volatility. And again, so when you use a short time frame, you will be full out of your mind, and the trade will be no longer the low risk trade. So actually, this is the idea that you will be like an undercapitalized, because you don't put enough threshold for the trade when you enter the smaller time frame. So for the survivor frame, this is not the main purpose of this video. But at least that we have the flow when you understand the invisible cost, and you go to the next step is you can do the position sizing. So basically it supports the position sizing step, and this position sizing is a important part for surviving. When you surviving, you will have more time to let your strategy and your ideas play out. So the purpose is that when you understand the cost, you will have the consistent position sizing, and then you will have consistent risk. And consistent risk can remove emotional bias, and it will help you to survive more. I also have a video like to prove to you like surviving can help to beat some funded program challenge very strict. rules and criteria. Okay, so the core takeaway today is that, yeah, you understand the cost of noise. Then you do the position sizing based on the noise that you understand. You will have the accepted level of loss based on the noise. And of course that you can estimate the risk of being wrong correctly, not by look at the price structure in a very deceptive way. You should look at the market price volatility to understand the cost. Thank you for watching, and I hope to see you in the next few videos.